All right, let's dive into equity bank shares, ticker EQBK. They just dropped their Q4 2025 numbers, and wow, what a story. Management is out there calling it a transformational year, but the market, well, the market seems to be telling a slightly different story. So let's peel back the layers and see what's really going on with the numbers.
Okay, so right out of the gate, you've got this classic good news, bad news situation. On the earnings side, they absolutely crushed it. We're talking an adjusted EPS of $1.21 when the street was only looking for 88 cents. That's a huge beat. But, and this is a big but, revenue came in a little light, missing by about $2 million. And right there, that's the puzzle we need to solve for this quarter.
So even though they missed the estimate, you can't ignore the bigger picture here. Look at this. Revenue is up over 25% compared to last year. That is some serious growth. And you better believe management was hammering this point home on the earnings call. This is like pillar number one of their whole bull case.
And pillar number two, it's all about the net interest margin, or NIM as we call it. It landed at a really healthy 4.47%. And get this, it actually ticked up a little from last quarter. Now, for any of you following the banking sector, you know that's a big deal right now. Margins are getting squeezed everywhere, so for EQBK to hold the line, let alone grow it, that screams operational strength. So this all feeds into management's big story. They're basically saying, hey, look, 2025 was a transformative year for us. And what they mean by that is they're not just growing the old-fashioned way. Nope. They are aggressively using mergers and acquisitions to totally change the game and rewrite what this bank is capable of earning.
And here it is, the big headline from their story. The CEO, Brad Elliott, came right out and said it. We're pushing to earn more than $5 a share in 2026. Wow. That's not just some soft guidance. That's them planting a flag. That's the anchor for the entire bull case they're trying to sell to investors. They're telling you a whole new level of profit is coming.
Okay, so you're probably asking, how on earth are they going to get to $5 a share? Well, they're basically planning to manufacture that growth through deals. The game plan is pretty straightforward. First, finish integrating the NBC deal they already did. Second, close the huge Frontier acquisition. And boom, just by doing that, they're adding something like $1.34 billion in loans and $1.1 billion in deposits. It's all about getting big and getting big fast.
So, there you have it. That's the bull case from management, right? Massive growth, a clear roadmap to that magic $5 EPS number. You'd think the stock would have just rocketed higher on that news, right? Well, funny thing, that's not what happened. Not at all. Let's take a look at how Wall Street actually reacted.
First thing you notice is the volume. Just look at that spike. We're talking almost 3 times the normal amount of shares traded hands. So, one thing's for sure, people were paying attention. There was a serious debate going on, a real battle between buyers and sellers. But here's the kicker. With all that action, where did the stock end up? Down. Not by a lot, but still, down. It actually opened up, looked like it was going to have a good day, and then just faded all day long. So think about that. Huge earnings beat, super bullish guidance for the future, and the market decided to sell the news. What does that tell you? And that really is the million-dollar question here, isn't it? If the story management is spinning is so great, why did the stock just fizzle out? What did those sellers see? The big money, the pros. What spooked them?
Well, there are a few potential reasons, a few clouds on the horizon. First up is just plain old integration risk. Trying to absorb 2 big companies at once, that is a heavy lift. One slip up, and that $5 earnings target could go right out the window. Then there's valuation. The stock's had a pretty good run. So maybe, just maybe, all this good news is already baked into the price. And finally, you can't forget that little revenue miss and the general anxiety about credit quality across the entire banking sector.
All right, so you've got this tug of war, right? On one side, you have a super confident management team with this big growth story. On the other, you have a pretty skeptical market worried about the risks. So let's put it all together and figure out where we land on this. So let's break it down, bull versus bear. The bulls are saying, look, this Frontier deal is going to be a home run for earnings. They're protecting their margins when nobody else can, and they're buying back stock and paying dividends. Simple enough. The bears, though, are pushing back saying, not so fast. The risk of them messing up these integrations is huge, the stock isn't cheap, and the whole banking sector could be in for a rough ride. So, when you weigh all that, where do we come out? For us, it's a market perform rating. And that lines up pretty well with what you're seeing from the big research shops like KBW and D.A. Davidson. The upside is definitely there, you can see it, but the risks are just as real.
We're in show-me mode. They need to prove they can pull this off before we get more aggressive.
Okay, so what are we expecting by the time the next earnings call rolls around? I'd buckle up for some choppy, sideways action in the stock for the next few months. The market is basically going to be sitting on its hands waiting for proof that this frontier integration is going smoothly. But if they come out in Q1 and show they're hitting their marks, that they're getting those cost savings they promised, then we think you could see the stock start a slow and steady climb up toward that $52 price target we've seen from some analysts.
All right, now for a little something extra, our wild but plausible trade idea. Let's say you're sitting there thinking, I really believe this management team can do it, but I'm just nervous about banks in general right now. Well, you could consider what's called a pair trade. You'd go long EQBK, but at the same time, you'd short a basket of other regional banks, maybe using an ETF like KRE. What this does is it basically cancels out the broad market risk. You're making a pure bet that Equity Bancshares' specific M&A story, their self-help plan, will make them outperform their peers no matter what the Fed does with interest rates.
So there you have it, our deep dive on the Equity Bancshares call. You've got a classic showdown, a company with a bold plan to grow versus a market that's saying, prove it. It's going to be fascinating to watch who wins this tug-of-war. We'll definitely be keeping a close eye on it. And of course, just a reminder, this is not financial advice.